Hi, everyone, and welcome. Today, we're going to break down the super important topic of business financing, and we're pulling everything directly from your ICAI material. Our goal here is to make these concepts really clear for your CA exams. So let's jump right in. Anjali, let's kick things off with a pretty big question. What's the one thing that takes a brilliant idea and actually turns it into a real, thriving business?
That's a fantastic question, Vikram. And the answer, really, is just one powerful word: capital. Money. So today, we're going to explore all the different ways a business gets that vital funding it needs to not just stay alive, but to actually grow and succeed.
I want you to think of it like this. Every single business, I don't care if it's a tiny startup or a giant corporation, needs fuel to run. And in the world of business, that fuel is finance. Simple as that. Without a steady supply, even the best ideas in the world, well, they just stay ideas, stuck on a piece of paper. So does that mean all financial needs are kind of the same? Or are we talking about different types of fuel for different parts of the journey?
That's a great point, and you're right, they're very different. First up, you've got your long-term financial needs. This is the big stuff, the foundation a business is built on. Things like a factory, heavy machinery, or the land it's all sitting on. We're talking about money that's tied up for 5, 10, sometimes even more years.
Then we've got medium-term needs. So this isn't for the building itself, but for all the important things inside that building that keep it running day in and day out. Think of essential spare parts, special tools, things like that. Here, the funding period is usually somewhere between 1 and 5 years. Okay, I think I'm getting it. Long-term for the foundation, medium-term for the key equipment, but what about just the everyday running of the business? And that brings us perfectly to our last category, short-term financial needs. You'll often hear this called working capital. This is the money you need for the daily grind, to pay for your inventory or stock, and to cover the bills until your customers or debtors pay you. This is all for periods of a year or less. Now, here's what's really cool about this. This whole idea gives us a perfect roadmap for our entire discussion today. We can literally classify every single source of finance based on whether it's long, medium, or short term. Understanding this structure is going to be key. Okay, to make this all feel a bit more real, let's make up a company. We'll call it Ch2. It's a brand new startup, just 2 founders with an amazing idea for an app, but they have absolutely zero money. Where on earth do they start? That's a perfect scenario. For an early-stage company like Ch2, the one word that defines everything is high uncertainty. Nobody knows for sure if this thing is going to work. And at this incredibly high-risk stage, the path almost always leads to one place: equity, usually from what we call angel investors. Okay, equity capital. For any students out there who are maybe hearing this for the first time, can you just break that down? What is it really?
Of course. Equity share capital is the most basic, fundamental source of funds there is. It's the money the owners themselves put in, or that they raise from other people in exchange for a slice of the company. It's permanent, meaning it doesn't have to be paid back, and it represents actual ownership.
And for a little startup like Ch2, this is just fantastic. First, it's permanent money. It's in the business for good. Second, and this is huge, there's no fixed rule that says you have to pay dividends. If Ch2 has a really tough year, they don't have to pay out a single rupee, which is a massive relief for a new company. But it can't all be sunshine and roses, right? There has to be a catch for the founders.
Oh, there is, and it's a big one. Control. Every single time the founders of Ch2 sell a share, they are selling a tiny piece of their ownership. They're giving up a little bit of control. And if they do that too many times, well, they could wake up one day and find they're not in charge of their own company anymore. And for the investors, the risk is real too. They might not see any money back for years, if ever.
All right, let's hit fast forward. Ch2's app is a massive hit. They are growing like crazy, and they need a ton more money to expand into new cities. They've officially moved from being a startup to being in the growth stage. What are their options now? So now things start to get a lot more interesting. I mean, they could issue more equity, but they're probably worried about giving up too much control. This is exactly where something called preference share capital comes into play. You can think of it as a hybrid, with some features of equity and some of debt. The big difference is that preference shareholders get paid their dividends before the regular equity shareholders do. And hey, exam tip for everyone watching. This table right here is pure gold. You will almost certainly be asked about these differences. The 4 key things to remember are who gets paid dividends first, the dividend rate, it's fixed for preference but fluctuates for equity, convertibility, and this is a big one, voting rights. Preference shareholders usually have very, very limited voting rights, if any. That makes a lot of sense. But what if Sarltech doesn't want to give away any more ownership at all? Is there a way for them to just get a loan? Yep, absolutely. And it's a very common path for a company that's growing. They could issue what are called debentures. A debenture is basically a long-term debt instrument. It's a formal IOU, a loan from the public or other institutions. Sarltech would promise to pay a fixed interest rate and then pay the whole amount back on a specific date in the future. So that brings up another really important comparison, doesn't it? Preference shares versus debentures. Exactly. And this table just brilliantly lays out the core difference. A preference shareholder is a part owner of the company. A debenture holder is simply a lender. The payment to a shareholder is a dividend, which is an appropriation of profit. The payment to a debenture holder is interest, a charge on profit. That means it has to be paid no matter if the company is profitable or not. You know, during this explosive growth stage, there's another major player that enters the game for a company like Sarltech: venture capital. These are special firms that invest huge amounts of money into businesses that are considered high risk but have the potential to be incredibly successful. And in exchange for that money, of course, they take a piece of the ownership. Okay, let's jump ahead one last time. Sarltech is now a huge publicly listed company. It's stable, it's profitable, everyone knows its name. Their financial needs are totally different now, right? They're not just trying to survive anymore. They're looking at big strategic projects. Oh, absolutely. And at this mature stage, a really powerful source of finance becomes available that just wasn't there before: its own profits. This is called retained earnings. It's simply taking the profits the company makes and plowing them back into the business to pay for more growth. And because it's an internal source, there's no giving up any control. Mature companies also have this whole menu of debt options. They can issue all kinds of bonds. One that's particularly interesting for us here in India is the masala bond. These are rupee-denominated bonds that are issued in foreign markets. It's a clever way to get foreign investment without taking on currency risk. And of course, they can get massive loans from big financial institutions like IDBI or ICICI. So as we've seen through Sarltech's whole journey, this choice of financing isn't just about finding cash. It's one of the most critical strategic decisions a company will ever make, and the right answer completely changes depending on what stage of life the business is. So if there's one golden rule that everyone should take away from all of this, what would it be?
It's this core principle right here. The most crucial point is to match the length of the funding to the length of the need. You just don't use a 1-year loan to build a factory that's going to last for 30 years. It sounds simple, but it is absolutely fundamental to smart financial management.
And that brings us to our final thought for today. We're going to put you in the hot seat. Imagine you are the CFO of the big, successful, mature Sarltech. You need to fund a brand new factory, a long-term asset. Based on everything we've just talked about, would you choose debt or would you choose equity? And more importantly, why? Really think about it, because that's how you go from just knowing these concepts to truly understanding them.